Good day, everyone. Good day. Today we'll be basically discussing about the beginner's guide to profitability. So for those that are just starting their journey to trade and they are willing to learn, I'll be dropping videos to help you with that. And this will be a playlist. This video should be a playlist. This is a beginner guide to profitability, and I'll be splitting this video. This particular playlist will be having 5 videos. Today we'll be talking about the first step, which is the analytical skill. So we'll be discussing 5 steps profitability, sorry, in trading. The first one will be analytical skill, which will be the one we'll be discussing today. The second is the risk management. The third is the emotional discipline. The fourth is psychology, that is having the right mindset, and the fifth is consistency. Today, this video will be mainly on analytical skill. In the consequent video, we'll be talking about the rest. So today we'll be discussing about the analytical skill. Analytical skill, and the analytical skill, we'll be discussing on mainly fundamental analysis and technical analysis. So, what is trading itself? When we talk about trading is just the act of buying and selling of financial instruments like stocks, currencies, commodities. It can be forex, it can be futures, it can be cryptocurrencies, just with the main goal and aim of making profit. That is just what trading is all about, just buying and selling of financial instruments with the main goal of making profit. And there are different types of traders. We have the scalpers, the day traders, the swing traders, and the position traders. Scalper, they just basically take trades for a very short time, very short period of time, often seconds or minutes, with the aim of making small profits repeatedly. Day trading is just buying and selling of a particular financial instrument within the same day. Swing trading is just holding position for days or week to capture a short or medium time move, while position trading is just a long-term approach, that is holding trades, holding your position or your trades forward for months and even years. So depending on your style of trading, but most traders in this recent time, they are all day traders. Most traders are day traders. Most traders are day traders. Now when we talk about analytical skill, we'll be talking about two subtopics, which are the fundamental analysis and technical analysis. Those are under analytical skill. Fundamental analysis is just fundamental analysis itself is just a method of evaluating or predicting the price of a particular asset by checking its underlying financial and economic factor. That is, it's just a kind of way of predicting the price movement of a particular asset by checking their underlying financial records and economic factor, or anything that can actually affect the price of that particular asset, which will help you to make a better informed decision on the trade you want to take on that particular asset. So basically, the fundamental analysis just check the underlying financial condition. They check the economic factor. They check geopolitical factors, any geopolitical news, anything that can actually affect the price of that particular asset. They check it, which they will use the results to make better informed decision about the trade they want to trade, which will help them to better predict the future price movement of that particular asset. Why technical analysis itself is just a method or a way of predicting price movements through studying historical data. Fundamental basically just use by just studying the underlying financial records or condition or economic factors or geopolitical factors that might affect the price of the particular asset. Fundamental does basically use underlying financial records and economic factors to predict the future price movement, while technical analysis just use historical price data to predict the and the movement, the price movement of that particular asset. Now we're talking about technical analysis. Technical analysis, basically, you have to understand so many things. You have to understand the candlestick anatomy, that is how a candlestick is being formed. Look at this candlestick. We have a very small candlestick here. This shows that what the sellers, they are not this bearish candlestick, this red candlestick, it's bearish. This shows that no much selling momentum. But if you look at this big candle, this shows that there's a very big buying momentum. Look at this big candle. So if you see a small candle and a big candle, you see that okay, there's a very big momentum here. Look at the small candles here. It shows that the bearish, the sellers, doesn't have any power. This is candlestick anatomy. It just kind of make you understand the psychology behind the formation of each candlestick, either small or big. We understand candlestick patterns too. Patterns, we have so many candlestick patterns you can learn. The bearish engulfing, which is this bearish candle engulfed this small candle. We also have bullish engulfing, when the bullish candle engulfs, look at it, this bullish candle engulfs this small candle. So we have so many candlestick patterns, which candlestick pattern actually help traders to make better informed decision about the trades they want to take. And we look at market structure, which is the main thing we'll be using in today's explanation on the analytical skill you have to have as a trader, which is the main purpose of this video. Now we're talking about market structure. Market structure in itself, it just helps us to learn how to identify the different types of markets, because in trading we have different types of markets. We have a trending market, a ranging market, and a chopping market. So that is the main purpose of this video. I'll be showing you all this on the chart here live. For a trending market, we have two types of trending market. We have the downtrend and the uptrend. What do I mean by that? Uptrend, as the name implies, it means the price of that particular asset keeps moving upwards. It keeps moving upwards, as you can see. As you can see, the price of this asset. Look at the price of this particular asset. It keeps moving upwards. Look at the price of this asset. As you can see, the price of the asset keeps moving upward. The price of the asset keeps moving upward. This shows you that, as you can see, just looking at it, you see that okay, this price of this particular asset keeps moving upward. It can be stocks, it can be futures, it can be anything. Look at it. The price of the asset keeps moving upward. It keeps moving upward. It keeps moving upward. This is an uptrend, just as the name implies, an uptrend. As you can see, the price of the asset keeps moving upward. As you can see, this is just basically an uptrend. If you want to use other terms, other traders prefer to call it. In trading, we have highs and lows. In trading, we have highs and lows. So as you can see, this is an uptrend. This is basically explanatory. Look at it. Uptrend means so the price of that particular asset keeps going up. As you can see, the price of the asset keeps going up. So this is an high. This is a low. This is an high that is higher than this high, which is an higher high. This is an higher low. That is, this low is higher than this low, which makes an uptrend. That is the formation of higher highs and higher lows. That is what makes an uptrend. Now going to the downtrend. Now I'm talking about market structure, and we have three types, which is the trending market, the ranging market, and the chopping market. For the trending market, we have two types, which is what I'm discussing. We've discussed about the uptrend. Now we'll talk about the downtrend. Downtrend is the opposite of uptrend. That is when the price of a particular asset keeps plummeting down. The price of a particular asset keeps going down. As you can see, this is a downtrend. As you can see, this is a downtrend. That is, the price of the asset keeps going down. It keeps going down, as you can see. As you can see, the price of the asset keeps going down. This is basically a downtrend. This is as explanatory as it should be. Downtrend, that is, the price of the asset keeps going down. It keeps going down, as you can see. So this is an high. This is an high. This is a low. This particular high is higher than this high. I said, sorry, this particular high is lower than this high, that it is an high, this is a low. This is a lower high, that is this particular high is lower than this high, and this is a lower low. This low is lower than this low. So that is a downtrend consists of what? An high, a low, and higher highs and lower highs and lower lows. Downtrend consists of lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. High and uptrend. An uptrend consists of what? An higher highs and higher lows, higher highs, higher lows, higher highs, higher lows. This is higher, this is lower. This is higher too. Higher highs, higher lows. While for a downtrend, they are lower. That is, we have the lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. But for an uptrend, as you can see here, we have the higher highs and higher lows, higher highs, higher lows, higher highs, higher lows. But for downtrend, we have the what? The lower highs and lower lows, lower highs, lower lows, lower highs, lower lows. That's what make a downtrend. Now we'll go to the ranging market. So ranging market is just basically a market that doesn't move past a particular range, just as the name implies. It doesn't move past a particular range. For example, let's give this particular defined range. For this particular defined range, for example, let's give this particular defined range. And when you notice market just keep bouncing at this particular levels, it keep bouncing and keep moving at this range. Market is not able to break it to the downside or upside. Just keep moving at this range. And this means what? The market is what's ranging. Then you should avoid the ranging markets because they are not predictable. They are not predictable. Always avoid the ranging markets in order not to lose your money. This is a ranging market, and I'll show you an example on the chart. Let's look for a ranging market. So for a ranging market, let's go down. Look at it. For a ranging market, are you saying the price of this particular asset? I'm sorry. As you can see, the price of this particular asset didn't move past this level at this point in time. See, it was just playing around this level. As you can see, it was not moving past this level. This is a ranging market. As you can see, the market doesn't move past, the price of the market doesn't move past this level. It keeps ranging before it broke out. Before it broke out here, you saw that the price of the asset keeps moving here. So that is a ranging market. Then we go to the chopping market. This is the chopping market. Let me give an example of a chopping market. For a ranging market, it just moved in a defined range. That it just moved in a range. For a trending market, it either moves upwards or downwards. A trending market either moves, as you can see, it moves either upward, as you can see here, or it moves downwards. But for a ranging market, it just moves in a range, while a chopping market doesn't have any direction. It doesn't move in a range. It doesn't move upwards or downwards. It does move in an irregular pattern. Let me give you an example. As you can see here, this doesn't have it is not moving upward, it is not moving downwards. Let me show you. As you can see, this market is not moving upwards, it's not moving upwards, it's not moving downwards, it is not ranging, it is just moving in an irregular way. Look at it. It is not moving upwards, it is not moving downwards, it is not ranging, because a range is just to bounce off a particular range. So let me make that very clear. A ranging market just bounces off a particular range, but no, look at this. This is not ranging. This is choppy. It is not ranging. It is not trending upwards or downwards. Look at it. Are you saying? Compare this. Look at it. It is not moving upwards or downwards. It is not ranging because it has to touch these highs and lows. This highs and lows. It has to be moving at this particular. Look at it. it's not going upward, it's not going downward, it is not ranging, it is just moving an irregular pattern. Comparing it to this, comparing it with this particular market here, comparing with this particular market here, you're saying this one is ranging because it moves from this high to this low, this high to this low. It's ranging. So a chopping market doesn't have a clear direction, it's just moving in an irregular manner. So that is just it. And that's just basically it for the video. If you enjoyed the video, please like and subscribe, and see you all in the next one. Bless you.